All right, guys, Friday, markets closed. We got to talk about what happened and what we set up for pretty much the next month at least from where we're at right now, what we saw with personal income and outlays, what it means in terms of the Atlanta Fed GDP now, what we see from the CME FedWatch tool, University of Michigan consumer sentiment, what that said in its final numbers. I'll tell you what, it's indicating quite a mess, but still, regardless of the market, up, down, you name it, we're anticipating this over in the Discord. We're trading based off what we anticipate today. For me, 21% on a strangle, and then tons of other panel experts out there with their trades, putting them out in the Trade Wins channel. You can also, if you join us over at the Discord, you'll join thousands of members in that community. 50% off your first month when you use code word CASH when you sign up. Take advantage of that. Come on over, join the party, whether up or down in the markets. We're there waiting for you. We're ready for it, chomping at the bit to share what we know, and you guys can be part of it. With that said, let's get over into what I have for you. We'll also bring on some technical analysis for the charts. So let's kick things off with the Atlanta Fed GDP now. And what I want you to see as you look at this is just this most recent tail end that we see of this. So you can see just this part, just this dip down is personal income and outlays when we got hit with personal spending, which I'll share those numbers with you from Trading Economics and you'll see that. But we went down to 2.8% for the first quarter, according to Atlanta Fed GDP now. And when they account for the gold export daily, about still negative 0.5%, which before that, we were still sitting on the positive side of things. So slower GDP growth to an Atlanta Fed GDP now that's like, hey guys, just so you know, there might still be some recessionary pressures that are there. And the market's like, oh, come on, this isn't the news that we needed. And I said that the market was teetering, that it was right there on the precipice, waiting to find out what we got for data today at 8:30, and then Michigan consumer sentiment at 10, also giving us its news there. So let's look at Trading Economics. Let's look at today. PCE numbers for core, 0.4, previously 0.3, consensus is 0.3. So what we had was higher inflation. Not necessarily going to like that downward pressure for the markets. And if we look on a year-over-year basis for core, that's this number right here, 2.8%. Previously, it was 2.7. Expected was 2.7. So not great for the markets, downward pressure for the market for what we got for inflation. And then we also got down for GDP. So lower GDP, higher inflation. Those are the opposite things that we want for upward pressure on the market. So pressure was not alleviated by this report. Instead, downward pressure was added by this report. And you saw today's sell, which wait until I talk about Bitcoin, by the way, which actually pretty, in my opinion, pretty exciting to see how much Bitcoin moved based off of this news. We'll get to that in a moment. Get Michigan consumer sentiment, 57, the lowest since November 2022. And then the 5-year inflation expectations, 4.1% when it was expected. The consensus was 3.9. So when you look at the consumer, which the consumer makes up about 70% of GDP, their overall outlook, according to the Michigan consumer sentiment, is that the economic outlook is not a great one, which isn't great for recessionary pressures. Because if the consumer thinks that recession is coming, then they start to hold on to dear life with the cash that they have instead of going out and spending the cash that they have because they're preparing for tough times. And then with that inflation looking upward to that, expecting that inflation to happen as well, definitely also has its own impact. So the 4 pillars that I talk about propping up markets, and is what you can see with the summary of economic projections from the Fed. We need high GDP. Right now that's in question. And it looks like maybe there could be economic contraction. So that might start to show cracks in that pillar instead of just suspecting that there could be cracks in that pillar. We need low inflation to prop up markets. Well, right now, inflation moving higher. The tariffs haven't even hit yet, but I'll talk more about that in just a moment when we talk more about the inflation side of things. And then labor market, man, the pressure is on the labor market to hold out the numbers right now. It is the last vest, is the last holdout, the last hope that we have. That recession hasn't necessarily come our way, at least according to the numbers that we see. And right now, we're just not seeing it. So Thursday, Friday of next week, I think JOLTS is Tuesday of next week. I think that's April the 1st. It's either April the 1st or April the 2nd for JOLTS. We can pull that up too. But still, pressure's on those jobs numbers. So the JOLTS numbers that we get, the first one, the non-farm payrolls on Friday of next week on April the 4th, and then also that unemployment rate. We want to watch for those. If labor market weakness is also put in there as well, that's 3 pillars out of the 4 pillars. And then the last pillar that we have is monetary policy, which I'm also going to put the CME FedWatch tool. According to the bond market, what they expect to have happening, we have a little bit of softness leading towards that. But if it's recessionary led easing of the monetary policy, well, the other three pillars are falling apart first before the monetary policy starts to ease, which means that the Fed was on their back foot, which means that they're behind again. But should they switch over to quantitative easing again and they lower the federal funds rate on top of it, those two things really put us into a situation where money's easier to come by, which means that it can stimulate the economy, which means GDP growth, and it can also we might be able to see some lower inflation there as well, but tariffs kind of complicate things a little bit as well. But if we get the economy going again, that can mean a return to work, a lower joblessness, a lower unemployment rate, a strengthening of the labor market. So we could potentially see that swing. Now, mind you, I'm not saying that recession is here, but it is something that the market is worried about right now. So just keep that in mind. That's why the market's selling, is because it's worried about recession. And, the evidence says that maybe it is here, and that's going to be the ongoing debate. But you can debate all day long that you want to of whether or not we're in recession. The market is afraid of it. And in that fear, the market's selling down. So let's go over to University of Michigan. Okay, well, that still doesn't want to load for me. So no big deal. We actually already looked at that. Let's go to the CME tool. There we go, 17.9% of a percent chance of a rate cut, according to the bond market, on the May the 7th, when that meeting concludes for the FOMC meeting. And that was at under 12% yesterday. Now it's looking closer to 18% that we get that rate cut coming up in May. Let's see where that borderline is. By June, there's over a half a chance, at least according to right now, and this changes daily throughout the day even. So right now, 63% chance that we get that rate cut in June, whereas yesterday it was 58%. We lost 10% chance to stay where we're at. The rest of it got shoved down to 1 to 2 basis point, 225 basis point cuts by the time June comes. 12.6% chance, that's not likely, but it's not unusual. Under 5% is unusual. We're well above 5%. So right now, I would say that the bond market's like, maybe if the data keeps on going the way it is, maybe it's looking like we need to see that easing of the monetary policy sooner, that we see cheaper money coming our way, some cheaper borrowing happening with the dropping of that federal funds rate. And well, that could potentially lead, if the Fed's hands are being forced by economic weakness, well, then they got to do something. And then quantitative easing would be on the heels of that. So if we go out to December, just to look and see what happened. Well, if you look a month ago, we had 27% chance, almost 28% chance of just 50 basis points in cuts. And now that peak is at 75. So 3 25 basis point cuts. And we actually, just from yesterday till today, so before today's numbers came out until after today's numbers came out, we actually lost 7% off this bar right here. And that 7% actually translated down this way, making it more likely to see that rate cut coming, or extra rate cuts coming, by the time December rolls around. So the market's sweating it. The bond market is sort of preparing for a little bit. We're seeing some of that softness come in. So what do we got in terms of the charts then? Well, let me take this down for you. We'll talk about what we can see with the charts and talk about the selling that we got. And like I said, Bitcoin is actually kind of exciting, at least in my opinion, with its performance that we saw as of the market close. So I said that from yesterday, this is the S&P 500 ETF SPY. So tracking the S&P 500, I should say. Yesterday, indecisive candle right near the 20-day, down below the 200-day. The market was ready to go in either direction, depending on what sort of information we got. And man, we just couldn't break up above it. Instead, we got a day that's down just a hair over 2% in the post market, down even a little bit lower from that. So we do want to watch and see if we break this previous low. We already have a lower high. If we get a lower low, that could say that potentially we go down even lower from where we're at right now. And I still have commentary for you guys about what I think is going to happen between now and when we get Q1 GDP on April the 30th. So I'll talk about that. So Q's down over 2.5%, almost down to its previous low. We could get a bit of a bounce coming off that previous low. You can see all the chop that we have back in here. We even have this previous peak back in March of 2021, before we had that chop coming through, before we could finally break out and go higher after that consolidation. I guess we could double bottom from here, but I don't know that we necessarily do. I think the market's going to be really, really worried about the labor market numbers that come up, especially because we really want to watch that unemployment rate happen. Like, there's a lot of pressure, added pressure on the other pillars to prop up the market if GDP is really in fear of having those cracks. So we need inflation to subside. Well, we don't get CPI and we don't get PPI until mid-April for March's numbers. And honestly, I think there's a good potential that we actually see more inflation coming from March, because we're coming up on the Trump tariff deadlines So April the 2nd, when we hear from Trump for that one, all that ordering, all that pressure gets put into March. We could see some of that spending take place. We could see those higher prices put in, see some temporary pricing power, if you will, that in order now to avoid the tariffs that could be coming down the road. And then what happens when the tariffs hit? Will we see that slow down in ordering? So we could actually see more inflation right up front. We could see companies passing more cost on the consumer for fear of tariffs, so that way they can protect themselves as companies further and weigh on the consumer some more. So I'm not totally hopeful about the inflation numbers that we get for March coming up in the middle of April. And then we have PCE numbers coming up at the end of April, on April the 30th, the same day that we get Q1 data for GDP, the advanced estimate that comes out. And I'll tell you what, that could be a time that we're going to have to see how it plays out. How bad do we expect it to get? And if it comes out better than what we expected, well, that could be an alleviating time. That could be a buy the news. That could be like a bottom. We want to watch for peak fear if this is something that we're going to get. So honestly, the inflation thing, I think that I'm not the only one who's going to expect that there's going to be some persisting inflation throughout March, especially as we lead into tariff time that's coming up here in April. So we'll see what sort of announcements get made. Maybe they won't be as bad. Maybe it starts to pull back from, okay, yeah, March was bad, but now the tariffs are here. We know what to expect. We get some certainty, and maybe the market's allowed to experience some levity, at least some less downward pressure if the tariffs end up being not as bad as we thought that they were going to be. They end up worse than expected, well, then that's another story. But we do want to watch for the cues this low that we're at right now. For IWM, where do we find ourselves on the daily chart? Not quite as low as we had previously. We're well down below the 50 and the 200. We're down below the 20. We're in bearish territory here for the Russell 2000 stocks. They're probably going to take it on the chin just a little bit worse. Now, mind you, they actually outperformed the NASDAQ 100 today. So I guess that's a silver lining when we look at it. So remember those pillars. I keep talking about them. We need strong GDP. Right now, it's feared that we don't have it. We need low inflation. It's feared that not only do we not have it, but there's fear that it's also going to increase from where we're at right now. I don't think we're at that peak fear moment yet. I think maybe we could see it a little bit more of it throughout April, and I'm going to set up my trades accordingly. So I don't think that we're at that peak fear. Now, what else? Labor market, that's in question. Next week, we get that data. So we want to watch that data. Strong data there is going to be upward pressure, or at least an alleviation of downward pressure on the markets. So watch the labor market data, JOLTS, non-farm payrolls, and then unemployment rate. So I believe it's Tuesday and then definitely Friday for non-farm and for unemployment. They're going to be huge for us. And then the pressure gets passed on from labor market to inflation then next. So we're going to keep on circulating around those pillars, and then all the while looking to the Fed for monetary policy. And then finally early May 7th, when the Fed comes out and talks, we want to hear Jerome Powell be dovish. We want to hear from him that, hey, the time has come. We got to make this cut. So that way we don't end up with the restriction that we have right now on the economy. It's been enough. We're going to pull back just a little bit. And we're also going to go from $5 billion runoff from our balance sheet down from $25 billion, by the way, which is huge. Maybe we're just going to hold it even for right now. If they do too much, it's going to seem like panicking. The market's going to hate that panic as well. So Bitcoin, what am I so excited about for Bitcoin? Bitcoin had less than a 4% drop as of right now as I record this video, when the rest of the market was between 2 and 3% for the S&P and for the NASDAQ 100. Go Bitcoin. Like, the fact that it's not more volatile right now, the fact that it didn't sell down more, what does that tell us? Well, yeah, risk off a little bit. So we see a little bit of that, but not 10%, not 15%. We don't have the same volatility that we used to have with Bitcoin, because it's not just seen as that risk asset anymore, in my opinion. Inflation hedge is one of those reasons why I think it's propped up as well as it has right now. And then also, like, what happens if the debt burden becomes unmanageable and there's any sort of economic collapse? I think that Bitcoin being that place where there might be that hyperinflation type scenario, I think Bitcoin's still being eyed up for that. I think it is a place that people are going to go, and they're going to hold on to that Bitcoin, and they're not just going to get rid of it because we go into a risk-off environment. And I'm not saying that it couldn't soften more from where it's at right now. I'm just surprised that it held up as well as it did. Now, mind you, I put a lot of this commentary out with earlier news from today. I put it out in my expert panel channel that I have over at the Discord, along with the other experts that are over there, leaving their commentary for the things that they're watching, the trades that they're posting. Remember, you guys can join us, code word CASH, when you sign up. It's really going to help you out. XRP, Also, not doing so bad. Like down 6%, not great, especially if you're holding on to XRP. It stinks to watch that. If you're somebody to dollar cost average or accumulate it over time, today's a red day. So, that's something that you could look at and be like, hey, I got it cheaper, No financial advice, but to me, I'd rather buy on red days than green. I'd rather sell on green days than red. So when I look at this, the fact that we're still right here, sort of still that head and shoulders pattern. I don't know that it's necessarily going away. I don't think that we go back to 54 cents as the technicals suggest for this one. We do want to watch and see where this floor is, see if it's holding up right around just south of $2. So just let me summarize this thing for you. I don't think that we've hit peak fear. I think that this most recent report kind of gives us a lot to reconsider, and it laser focuses the eyes. It puts more uncertainty and more pressure on the other pillars to prop up the markets. And so if that data come out, if the labor market data comes out in any way weak from where it's at right now, much lower than the expectations that we have, that's going to be 2 out of the 4 pillars. So that's really tough to prop up the market the under 2 then. Then we have to rely on low inflation, which we know we don't have. And then we have to wait to hear from the Fed about monetary policy. So in my opinion, I think we might have a little bit more pain ahead based on this, at least from what I know today as of Friday. That could all change from what we hear over the weekend and then what we hear on Monday. We just have to keep on assessing this day by day and keep on bringing it back here to you on YouTube. Just let me know. And my goodness, just let me know. You can let me know down in the comments, but subscribe so that you can see anytime that my videos come out, especially if you're ringing that notification bell. If you want to talk to me over at the Discord, you can. You can also talk to the other expert panelists that are over there as well. Use the code word CASH when you sign up. You guys can also learn about technical analysis. Technical analysis trading is the bread recipe. You can also learn to trade options through the link in the description for Stockmo Academy. It really, both of those things help to support me. They help to support this channel. They help to support my family. When you sign up for the courses, use code word DOCTOR. That's also going to save you a ton of cash. And there's tons of testimonials coming out all the time about how using the bread recipe trading strategy, the knowledge that they gain in those courses, allowed people to cover the cost of those courses in as little as 1 trade. So guys, take advantage of them. Down in the description. Let me know what you think down in the comments. I'd love to hear from you. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning. We'll see you next video.